All right, welcome everybody.
Hello, hello.
Welcome, welcome. It looks like we've got some people joining us. Fantastic. Great. Welcome to the webinar. We're just going to give everybody just a minute to go ahead and get settled in and get yourselves ready. Just as a reminder, this is in webinar mode, so we cannot see your faces, nor can we hear you. So if you want to just give us a little hello in the chat, we can make sure everybody's here and can see us, okay? You can just type in hello, I can hear you, or we're good to go. That would be great, just to kind of let us know that technology is working and you can hear us. Great. Thank you, Charlotte. Fantastic. Thanks, Crystal. Hi, Amanda. Great. Thank you, guys. Good to know that. Hi, Nicole. Thank you. So good to know that technology is working appropriately and you guys can hear and see us. And if you can just give me one more confirmation, somebody, that you can see this shared screen. It says Lunch and Learn and has our beautiful pictures on there. Thanks, Becca. Hi, Hector. Nice to see you. Okay, thanks, Charlotte. Good to go. Okay, so we are 2 minutes after the top of the hour. We're going to jump right in because we have a ton of stuff to share with you guys. If you don't know me yet, I'm Laurie Lee. We organized this webinar because as business owners, your ownership in your business is an asset. And so while we are business attorneys, you need to keep an eye as a business owner on your assets. And so as part of that, managing your assets, we have Mark Moss here, who is a estate planning, probate, and elder law attorney. And we have Kendal Fordham Cann, who is an amazing financial advisor. So we're going to do a little bit more introductions, but just to kind of give you the gist of what the webinar is about today, it's about where business ownership overlaps with managing all of your assets, because business ownership is an asset. So we're going to talk about how and when our practices overlap and what you need to know as a business owner and how to manage those things. All right. One more housekeeping thing. So while you said hi to me in the chat, we are going to not be able to keep up with the chat for questions. So we love questions. We're going to save some time at the end, and we are going to answer your questions. So if you can put those into the Q&A. So if you can hover over the menu, it says Q&A. If you can pull up that one, drop in your questions as they occur to you. Sometimes we'll stop and answer them if it's pertaining to what we're talking about. Other questions we'll save for the end. All right, I think I just need to make sure recording is going, which it looks like it is, and we are ready to rock. Okay, so just to recap, we're talking about life, estate, business, and financial planning, ensuring that you're protected from every angle. I am Laurie Lee. I am a business attorney. I have been practicing business law for 20 years. In the past almost 10 years has been with my own firm, which is called the Legal Department for Service Professionals. All of our clients happen to be service providers, licensed, regulated, educated. You do your profession, and then you happen to have your own practice firm business. And so in that context, you are a business owner. So we serve as business attorneys to those types of clients, typically small firms under 20 employees. Mark, I'm going to let you introduce yourself next.
Excellent. I appreciate that. My name is Mark Moss. I own my own practice focused on estate planning, probate, elder law, asset protection. And we do that in Florida and Georgia. I think that's really what I've got for myself. I'm not one that likes to talk about myself, which is weird for attorneys, but I'd rather talk about clients and how we can help them and other things like that, and not myself.
Okay, well, we'll hear from you again soon. Kendal, you want to do your introduction?
Yes, my name is Kendal Fordham Cann. I'm trying to drop my maiden name and go with my married name. It's way cooler. So we'll say Kendal Cann. I am the owner of Privilege Planning Incorporated. We are a fiduciary wealth management firm who focuses on small business owners and their families, high earners who hate their job, and divorcees.
Very good. All right, let's jump in with Mark first. So in order for you to understand what we're saying in this webinar, Mark's going to give you a 101 quick rundown of how do you manage your life planning, as he likes to call it. I love that change in wording there, Mark. So I'm going to go through your slides. You tell me when you want me to advance, and we'll go from there.
Beautiful. So I will start my clock to try to keep myself on track here. So as Laurie mentioned, I do refer to it as life planning over here, not estate planning. Not everyone thinks they have an estate, but arguably everyone has a life and assets worth protecting and planning for. So next slide for me, please. And as Laurie mentioned, this is, or kind of alluded to, this is going to be part one, maybe of kind of a multi-part series, but we're going to hit the high points now so that we serve, or this serves as the foundation for subsequent webinars. So first things first, the big scary elephant in the room, probate. So not everything that you own goes to probate. Essentially, if you own assets that are jointly titled with a right of survivorship, you have valid beneficiary designations, or you have pay on death, transfer on death designations, those bypass probate. Anything you own individually that does not have instructions of where those should go, and by instructions, I mean a right of survivorship, beneficiary designations, or in the case of business owners, an operating agreement that's going to govern where assets and where ownership should go. The default is for them to go through probate. Next slide for me. So high level, what makes up a complete life plan? Last will and testament, most people have probably heard of. That's the cornerstone. Additional documents that go into that are your living will, healthcare surrogate, HIPAA release, a pre-need guardian, and I'm going to go through these in more detail here shortly. A durable power of attorney, and then trusts. And there are various types of trusts. I think at last time I looked, kind of like Baskin and Robbins, there's 30 or 40 different types, and there's new ones being created all the time. So there's no shortage of what types of trusts we can create as well. Next slide for me. So last will basically serves one or two purposes. Disposes of your property at death, and your instructions. What do you want done with your body or your ashes? And it shows your testamentary intent. In plain English, if there's a fight over who gets what, this document shows your wishes. Limitations of a last will. It's limited on what it can do and transfer. It doesn't avoid or prevent probate. We'll get to some other issues with that as well. And then it only transfers upon death. It does not give authority to do anything during your lifetime and doesn't allow anyone to assist with your health decisions, financial decisions, or anything else during your lifetime. Next slide, please. Advanced directives. Easiest way to go through these and explain these, anything that is not a last will or a trust. Everything else could be considered an advanced directive. So again, you have a power of attorney, healthcare surrogate, or in some states that's known as a healthcare power of attorney, HIPAA release, living will, and a pre-need guardian. So if you go next slide, we'll start talking about some of these advanced directives. A very common one is the power of attorney. This gives another individual the authority to act in your place, you being the principal who establishes this. There's different types of power of attorneys. There's limited versus general. Limited essentially is, I want someone to sign and sell this house for me or sell this vehicle. You're giving someone authority for a specific purpose, but that's it. General, kind of like the name says, it's general, it's for everything. Then you have durable and non-durable. A non-durable power of attorney might have some use and benefits somewhere, but in my world and what I do, I don't see those benefits. The reason being, a non-durable power of attorney states or says that when you as the principal lack capacity, your agent cannot use it. So it essentially is not good once you become incapacitated. So if we're talking about death or incapacity, you have this authority, but as soon as you become incapacitated, it's no longer valid. The other nuance is power of attorneys in the state of Florida are effective as soon as they are signed. It does not require that you lack capacity. it is effective as soon as it is signed. So that's something to always keep in mind in the state of Florida as well. We do have ways around that, but the statute says they're effective immediately. Next slide for me. Living will. Essentially, this is great for a limited situation. All of these have specific purposes. That's why they're all individual components to make a complete plan. But this tells your family, the medical professionals, and arguably the world your wishes if you are in a terminal condition, a persistent vegetative state, or an end stage condition. Do you want life prolonging procedures or not? So that's what that is good for. And now, one of everyone's favorite topics on the next slide, trust. So everyone hears about it, everyone sees them online. Trusts are the greatest thing in the world. They fix and cure everything. Hopefully you guys can pick up, there's a little bit of sarcasm there. I like trusts. I think they have their purpose, but I don't think they're as great as everyone on TikTok and Instagram and any other platform makes them out to be. So on a base level, there's different types of trusts. Most commonly, you have living trust versus testamentary trust. A testamentary trust is a trust that is established during the probate process. So it is created in your last will, but it is not done during your lifetime. Versus a living will that you set up during your lifetime that you can funnel and transfer assets into during your lifetime. So you no longer own them, the trust owns them. There's also revocable versus irrevocable trust. An irrevocable trust is less common these days than it was 5, 10 plus years ago. Reason being is an irrevocable trust, you have to give up control. You have to transfer assets into that trust, and you have a third party as trustee. That third party cannot be certain family members, employees, other individuals. So you lose a lot of control. So unless we need to use those maybe for Medicaid or someone is over the federal estate tax threshold, we might look to that. Otherwise, we use a revocable living trust that allows you as the trust maker the ability to make changes and amendments during your lifetime. So next slide for me. And I know we don't have much of the ability to get some interaction here, but if those, if people can type in, I don't know if they can raise hands and show, but does a living trust avoid probate? Does anyone have the answer to that? Good. I see Kendal and Laurie have their hands up. I love that. I don't know if I can see anybody else. Laurie, you might be able to, but if not, that's fine. The answer, like most good legal questions, is yes, no, and it depends. So a living trust by nature should avoid probate. Assets are transferred into it. You no longer own them, the trust does. However, the statutes in the state of Florida, I'm not licensed anywhere else, I can't speak to other states. In the state of Florida says that assets in a trust are subject to the trust maker's creditors. So if the goal of a trust is to avoid creditors and distribute assets directly to the beneficiaries, a trust is not the best way to do it because those assets are still subject to creditor claims. So there's other ways around that. So a trust does not entirely avoid probate, but it does have some great benefits. And again, to me, it's very situational. I don't recommend it for every client, but they are great for certain situations and instances. So on a high level, those are your core life planning components. And we want to make sure that we have those in place for you personally, and then work with Laurie and Kendal as far as the business goes to make sure that the business either funnels into the trust, has an operating agreement, has the correct plans in place for the business so that each work together. So
that's right. So you can start to see from Mark's laying of the playing field, when you have a business as an asset, where does it fit into all of these documents? So where does it fit into a will? Do you leave the business ownership to someone through the will? Or do you do some sort of transfer on death designation where The business automatically goes to somebody upon your death and doesn't go through probate and is not in your will. What about your powers of attorney? If something were to happen to you, who controls the business assets and the business ownership? You haven't passed away, but there's something going on and you aren't able to make decisions. All of those business ownership issues come into play in Mark's world, where he's drafting these wills and trusts and powers of attorney for business owners that are going to be very specific to you. And I think, Mark, you and I both we've worked on mutual clients before, where sometimes we put the business inside of a trust and sometimes we don't. And depending on the situation, that may be a good thing or not for you. But now we're going to switch over and talk about money for a minute, because now Kendal's going to come in and, with financial planning and looking at long-term finances and looking at your assets and how do you manage the financial piece of that when these assets are producing money. So Kendal, take it away. Here's your next slide.
Thanks, Laurie. So in my slides are really catered towards the person who's a new business owner, and how do these things interact with each other? You're a business owner, now you have business finances and your personal finances, in addition to how that works with succession planning and estate planning. And I will say, how approaching what Mark was saying earlier, most of the people that come into my office, we talk about estate planning, and I tell them, and maybe this is wrong, Mark, correct me if it is, I go, the bare minimum is a will. That is the bare minimum. And then beyond that, look at what you have. What can you create a POD, a TOD, add a beneficiary on that avoids probate? And then afterwards, if there's anything left over after that, now we go to an estate planning attorney and we figure out how can we avoid probate, how can we maximize our tax or minimize our tax liability through estate planning. Am I going about that correctly, Mark?
On a high level, yes. I think that
Yeah,
a will is good for death. Other stuff is good for other things during your lifetime. I think you need a will is a great cornerstone, but that is the starting point for sure in everything. Even if there's a trust, you can't have a trust without a will,
absolutely.
or at least you should.
Okay. So I wanted to touch on that because it can be very overwhelming for people, especially in a webinar setting where, we're diving into all this. But one thing I want to touch on, because it's something I've seen in my office very frequently over, I would say, the last 5 years, is social media and its presence on how we're structuring our businesses, how we're making decisions in our businesses. And I, of all people, love the information that we receive on social media, but I also believe that you have to verify what you're looking at and what you're receiving, because these people are trying to get branding and likes and comments, and a lot of times it's just not true. And that's why I wanted to start it with structure. There's a ton of structures. I'm going to briefly go over the most common ones, but specifically, I really want to focus on the S corporation. So that's become a huge buzzword for whatever reason on social media, and it is an amazing designation, an amazing structure, if you will, tax status. What the problem being, and Laura, you can speak to this, is when you're part of an S corp, you are required as the business owner to take a reasonable salary. And that's loosely defined in the code, but it has to be a respectable salary compared to your industry. And I'm seeing people come in, let's use an example of a pressure washer where they make 60K in their business, they just started, and they have to use all of that to pay their bills. And then they're structured as an S corporation. Now, S corporation, the complexity of it is a little bit more complex. There's the cost of administration is there. There's a little more that you have to do to keep up with it on an annual basis. So if you don't need to be that, if you're using everything that you make in your business, you shouldn't be an S corporation yet. So I encourage my business owner clients that come in, let's reach profitability first, and then look at the different corporate structures. So I wanted to touch on that first. So we'll go over in general the basic ones real quick. We have the sole proprietor. That's the simplest form of the business structure. Most people, when they're good at something, are like, I want to make money doing this. They just go full throttle at the sole prop. It's the least beneficial for you in pretty much every single way. example, a freelance graphic designer who owns and manages their own business independently would be a sole prop. It's my least favorite. And if you are a sole proprietor, I would strongly suggest you look at these other ones. The next would be a partnership. That's a business owned by two or more individuals who share responsibilities, profits, and liabilities of that business. And within that, there's two subcategories. We have our general partnership. You see a lot of law firms do that. That's where everyone's equally contributing in that partnership. And then you have a limited partnership below that. And that's where you see, someone's running the day-to-day business, but there's another person who doesn't have decision-making power per se. Maybe they're the financier. Maybe they're the one who puts money into the business. Then you have the LLC. That's definitely, I would say, the most popular one. That's a hybrid structure that provides the legal protections of a corporation with the tax benefits and operational flexibility of the partnership. Owners are called members in this case, and they are protected as long as you stay compliant from personal liability and business debts, and profits pass through to their personal tax return. You see an example would be a tech startup, for example, that wants the liability protection associated with the LLC, but the tax structure of that partnership. Next would be the C corporation. That's a legal entity that separates from its owners. You are not, that is it has its own EIN, or it's the social security number of the corporation, provides definitely the most protection from personal liability, but with that comes much more complex regulation and tax requirements. It's definitely the most expensive to administer. It's owned by the shareholders and managed by a board of directors and subject to the double tax. A lot of people have heard about that. The keyword, the double taxation, don't get double taxed. And that's why it's really not appropriate for most of us that are starting a business. And but you do see that for most public companies are going to be a C corporation because it's most favorable for that type of business venture. Then we have the S corporation, a very popular one, similar to a C corporation, but really designed for smaller businesses that want to avoid that double taxation that we touched on a little bit earlier, because profits and losses can pass through to the shareholders on the personal tax return. Shareholder, you being the owner, would be a shareholder. There is a limit on the number of shareholders that can be had, and they all have to be, I believe, U.S. citizens and residents. I see most of my clients are S corporations that are established businesses. A popular one would be a family-owned restaurant chain. That's like a textbook example of a S corporation structure. And when I was studying, they always used restaurant chains for some reason. Lesser known ones, but for whatever reason, more people are doing B corporations. That's a type of for-profit corporation that includes positive impact on society, workers, the community, the environment, in addition to a for-profit institution. These have to be legally defined and very well documented, must meet the standards of the Social and Environmental Performance Accountability and Transparency Act. And my favorite example, and really the only one that I know of that's mainstream, would be Patagonia, they're known for their commitment to the environment and sustainable business practices, especially locally where they operate. And then you have just the regular nonprofit, an organization that's formed out of charity that can be educational, religious, scientific. Obviously, it's a tax exempt status. That's the 501c3, funded through donations, often tax deductible for donors. I mean, we all know what a nonprofit is. I see a lot of people trying to enter into this space recently. You have to be careful. And for whatever reason, the main thing that people seem to forget is that you have to have a board of directors. There has to be minutes. You can only operate for so long without these defined roles as a board of a director. I can't remember the exact time frame you get in the state of Florida, but after a certain period of time, if you don't have a defined board and you're not having regular meetings and taking minutes, you'll lose that status. But those are the main ones I wanted to go over. I think it's important. If you have any other questions, we can dive deeper. I think we could dedicate a whole webinar to the business structure section alone. Next slide. maybe you're already on the next slide. I can't really see. There we go. Operating agreement. So in the state of Florida, and there's several other states, we are not required to have an operating agreement, but we should be. And I wish that it was required, because very rarely do I have a small business owner that comes in that has this. And it's so important. I mean, Laurie, you can speak to this. I believe you put together mine, which is not called an operating agreement. So an operating agreement really pertains to an LLC, but the concept is the same for a partnership. It's a partnership agreement. If you're a corporation, it's bylaws. People, let me tell you how important. I've seen it firsthand. One, protects your business limited liability status by formalizing the separateness of the business from its owners. I mean, this is important because it helps protect your personal assets from your business risk or your business liabilities. Secondly, would be customization. Without an operating agreement, your business is governed by the default rules set by our state. And very rarely do you want the state to decide what happens to your business in case of an emergency. Your operating agreement will trump that and define the customized laws in which to govern your business in case it needs to be governed by someone other than you. Thirdly would be financing. Investors, specifically my husband and I, we've invested in startups before. I don't care if it's required by the state or not. You're not going to get any money from me unless you have some type of agreement in place, hopefully multiple different types of agreements. And the same goes for some banks, even in the state of Florida. Then conflict. I mean, it doesn't matter if you open up a business with your best friend, your mom, I mean, honestly, if you open up with business, conflict's probably more likely to happen, but it's going to happen regardless. An operating agreement, I'm not going to say avoids conflict, but it definitely reduces the time you're going to spend on it, because a good operating agreement is going to cover how you have to handle changes in ownership, dissolution, any type of decision making, any type of decision you're not going to see eye to eye. That operating agreement is going to set forth how to handle those things if it's done correctly. And then lastly, I would say succession planning. I mean, Mark, you can speak to this. I mean, there's many different ways you can define succession planning for your business. At the bare minimum, it should be defined in your agreement, your general agreement for your business. It specifies what happens if members leave the business, pass away, which happens more often than not where someone passes away. I mean, if you don't have these things written down, you're usually depending on what the spouse or partner wants to do with it, and that doesn't usually go over that well. This is just incredibly essential for long-term sustainability of a business. Go to the next one. I think we're going to do retirement benefits next one. So we're going to go over to my pretty little accidents. Commingling finances versus marrying finances. You'd be surprised if you're watching this, how many people, especially when they first start out, are commingling their personal finance and their business finances. And I want to go over why that can really kick you in the butt. The legal distinction that we touched on earlier applies to this as well. This is particularly important for LLCs and corporations. If personal and business finances are mixed, this is known as piercing the corporate veil, which I'm sure Laurie can speak a lot to more than I can. But the courts may hold you personally liable for business debts and obligations, and that can lead to your personal assets like your house, your car, your savings at risk if the business incurs debt or legal issues. Then I would say tax compliance. They can trigger if obviously we all know audits are unlikely to happen, but boy, they do. They're never fun. And if you are an IRS audit, this will result in penalties, and it also can reduce the tax. They can look at the deductions you're taking, exceptions what's the word I'm looking for? Credits that you might be applying for. And if you're commingling, they can take those away. And I've seen that happen. And then lastly, I would say financing. I mean, commingling can definitely complicate the process of you getting a loan through a bank, which is already an incredibly lengthy process. But also from an investor standpoint, an investor is looking to minimize their risk. And if you are not organized enough in your business, because remember, there's a 5-year look back usually, depending on the industry. If there's a lot of risk involved, they might look farther. And if they see that at any point in the recent past you were commingling, that doesn't represent an organized business. So I would say those are the main reasons you really want to separate as soon as possible. And it's really not that difficult once you start doing it. But separate, have a business credit card, a business debit card, a business check, business checking accounts, probably multiple checking and savings account for your business to properly track its health, number one, and be a responsible business owner. Next. Emergencies. This is a common question that I've gotten on my podcast and my webinars in the past. And it's real simple. I'm going to glide right over it. My rule, you're going to get a different answer no matter who you talk to, but this is my rule and people seem to like it, so we're going to go with it. I want to see 3 months of your bills in a readily available account. It could be a money market, it could be a checking account, it can be a savings account. I don't care. If something happens, you can get it within 1 business day. I want to say 3 months of non-discretionary expenses. That means bills you would have to pay if you were to lose all your limbs and you couldn't work anymore. That's your rent. That is, I consider your cell phone bill a non-negotiable. All your debt payments, utilities, your mortgage. Personally, I would say tithing or giving to religious organizations is a non-negotiable as well. But 3 months, and then I want you to add 1 month for every dependent that depends on you financially. And typically that brings at least the people that come into my office around 6 to 9 months of expenses. Now, fast forward, if you're in retirement, that doesn't apply to you. I want to see 12 months, 12. And I define retirement as you are not working. You don't have a side hustle. You're not Ubering. You're not jingling the bell for Salvation Army. You're not working. For a business, I want to see 3 months of gross operational expenses. And then I want you, and if we don't know what gross operational expenses are, let's Google that. But then I want you to add a month if you have a seasonal type business. I want you to add another month if your business faces high degrees of regulatory risk, meaning that regulations constantly changing and it's constantly affecting your business. An example would be like a Tesla type company. I mean, the rules are constantly changing. They're having to adapt. Then thirdly, I would add a month if your turnover ratio in your business is more than 20%. That is considered a moderate turnover ratio. If you don't know what a turnover ratio is, go ahead and add another month until you figure it out. That's my rule for businesses and personal emergency fund budgeting. If you have any questions on that, it's pretty straightforward, but we can definitely attack that. And employing your babies. This is one that is another social media. I mean, man, TikTok really hammered this in. I get a video on this from someone different at least once a week. Employing your babies. Yeah, it's an amazing, I do it. It is an amazing way to take advantage of the tax code, of the benefits of being a business owner. But people, there are rules. You cannot just, put your baby on the payroll and start paying them $100 grand. There are rules that apply to this and you have to follow them or it will come to bite you in the butt. I have to say, I'm not a CPA. I have to say that for Big Brother, but everything I tell you is from experience. So parental business exemption, FSLA, I believe that's the acronym. They govern the federal child labor laws. Now, the parental business exemption gives the exemption to where most of that, 90% of that doesn't apply to you anymore if it's your own kids that you're employing. Now, even if a business is a family owned and operated, minors are still prohibited from engaging in work that is considered hazardous. Federal standards define hazardous as operating heavy machinery, working with dangerous chemicals, heights. Common sense stuff, but we're working with electricity. So if you want an extensive, exhaustive list of that, I can provide that to you. But some of these, they're not unfair what they are considering hazardous. Work hours and age restrictions do not apply under the parental exemption. This means that parents can employ their children at any age and for any number of hours that they see fit, as long as it does not interfere with school. Your kid cannot have documented absences that are due to work. Point blank, period. Tax implications. So for family-owned businesses structured as sole props or partnerships, wages paid to children under 18 are not subject to Social Security and Medicare taxes. And then in addition to that, wages paid to children under 21 are exempt from federal unemployment tax, FUTA. So these are great benefits. I mean, beyond that, you can, once your kid has a job, obviously you can set up retirement accounts for them through the business or outside of the business, and setting your kid up with that, the sooner the better. I mean, $50 a month when your kid's 5 is millions of dollars by the time they're retirement age. So definitely something to begin sooner rather than later. I will say, if you are employing your child and you're going to take advantage of this, which you should take advantage of it all the way up into the gray area. Document everything. If you are giving other employee and staff an employee engagement contract, any type of contract you would give another employee, your child needs to have signed. Period. And it needs to be documented. They need to be on the payroll. Don't pay them under the table. Don't pay them, a check, pay them the exact same way you would pay another employee. Because if you get audited, you have to be able, or you end up in court for some reason, you have to be able to legitimize the arrangement. And that's about what I would say about employing your babies legally. Thank you, Laurie.
Thank you, Kendal. That's awesome. And as you guys can see, you're starting to kind of see how the overlap happens, right? So you're the business owner. You're looking at, this is an asset of mine. What happens if I die or if I become incapacitated? And you're also looking at it as an asset for financial planning, because now you're looking at the tax structure. So Kendal went over a lot of tax structure and business structure, all of which have implications on the financial side of things. So as she was going over all of the different types of businesses, all of that has tax and finance implications. And obviously, when she's talking to business owners, all of these things come up about ownership and documenting, because when something happens, tax-wise, life-wise, the law is going to follow what's on the paper. So those operating agreements are incredibly important, because no matter what arrangement you have, right, Kendal, you can talk about it and like, hey, this is how we're going to do it. But the paper is just something we got online. We're just going to sign this thing. And then when the poop hits the fan, what's going to happen? People have differing memories of things, don't they? And you're like, well, I remember we said this. And Kendal, you're like, no, I said that. And now we've got a conflict, right? So obviously you're dealing with those things as a financial advisor, and doing some planning on that side of things. And then obviously just funding of the business and keeping the business, sufficient to meet its obligations, but while also having the business, support its owners financially. And how do you bring that money into your house, and how do you spend that money? And all of that money management is incredibly important for business owners. So Kendal really touched on all the hot topics. That the child employment is a great one, because legally we don't always think about that as a good option, but on the financial side, Kendal's right. It can be an amazing money management tool to help with some tax reduction, but it can also help with managing the money flow that comes out of the business into your household. And how does that come into your household, right, Kendal? It can come in so many different ways.
Yeah.
So that's a great option. I want to go ahead and jump into, and again, I'm keeping my eye on time here. If you guys have any questions, pop them into the Q&A. We're happy to do it, to answer questions. So I'm going to come in at the end here and kind of tie those two pieces together. We're going to tie together the life planning from Mark and the money management piece from Kendal. And we're going to talk about how does that really fit into the business itself. And while, you know, Mark and I are legal experts, we went to law school, Kendal's the financial person, you can see how we all overlap. I mean, Kendal knows a lot about the law. Mark knows a lot about tax. I know enough about tax to be dangerous, and the money management part of things. So we all have these overlapping areas, but we have our individual areas of expertise as well. So while we work together often, we bring in each other's expertise. We know enough to know, hey, we need to work with you. I need to talk to your financial advisor. I need to talk to your CPA. I need to talk to your estate planning attorney. And we all kind of coordinate that because of all these different pieces. But the basic foundation of all of it is the business container and the proper structuring. So I'm a visual person. I visualize the business as a box. Mark and Kendal have both have heard my box analogy so many times. But you picture the box, and the walls of the box are your liability shield. You as the human are outside of the box. You own the box. And whatever goes inside the box, you know, is inside the business. So the box is a container for your business, and you need to choose what kind of box you want, because that box is going to make a determination not only on the legal side, but on the tax and financial side of things. And so this whole box analogy is great, because when Kendal was talking about a sole proprietor, guess what? Sole proprietors don't have a box. It's all on the human. There's no liability shield for a sole proprietor. And Kendal was talking about the financial part of things, about that's not so great on the finances, but it's not so great on the legal side either. Same thing for partnerships, general partnerships especially. There is no box. It's just multiple humans doing business together without a container. Again, all of that liability is on your shoulders as humans. Limited partnerships are a little bit different. They do have a box, but it's a wacky box. It's an expensive box to set up and manage. It's typically done by really, really sophisticated people like real estate developers and people who have some tax things going on, that they're using advanced tax strategies. So normally small business owners are not dealing with limited partnerships, and normally we're not dealing with partnerships at all because of the liability issues. So kind of give you a sense here of the playing field is every business is born in the law first. It is created in the law, and then it gets taxed. Just like we as humans, we're born and then we're taxed. So the legal stuff comes first, and the only fourth options you have on legal are sole proprietor, partnership, LLC, corporation. That's all the four you get on the legal side. Then on the tax side, you have additional options. You've got S Corp, C Corp, and then Kendal mentioned nonprofit. Those are on the tax side only. Those are not legal designations. So you choose a legal designation, and then you choose the tax side of things. So keeping in mind, there's two different sets of rules. There's the legal rules, which are usually by your state. So Florida has a lot of legal rules, and you set up the business under state law. What you do as a business can sometimes be regulated by the federal government, but then the tax is done by the IRS, Internal Revenue Code. So there's a lot of overlapping rules here. And I want to mention, while we're still on the container here and the proper structuring, if you choose an LLC on the legal side, you have all four options on the tax side. So it is a wide open choice, which is great, because you can choose to have a legal liability shield. You still have a box, you've got a container, you've got that in place on the legal side, and you've got all kinds of flexibility on the tax side. The only caveat to that is that if you are a single owner, an LLC is not so good for you, because it is a blended way of getting to an LLC. All these different laws are blended together, and when they blended together, there's a little hole that got created for single owners, and you don't have a full liability shield for single owner LLCs. And that's one of the reasons why we as a practice don't form single owner LLCs if it's owned by a human. You know, if you've got multiple layers of businesses, that's a different story. If you've got some trusts involved, that's a different story. But if it's a human owning 100% of an LLC, that's typically not a good scenario on the legal side. Tax side, there's no issues on the tax side. You still have 4 options on the tax side, lots of flexibility. So when Kendall's talking about S corps, you know, if you're an LLC on the legal side, taxes an S corp, that's great. The only time it's not great is if you're a single owner on the LLC side, taxes an S corp on the tax side. Again, I'll say that again. The only time it's not great is if you're a single owner LLC on the legal side, taxes an S corp on the tax side. That's the only caveat to the whole container conversation. Otherwise, all of those choices that you make are important because of number one, you're managing the money, and number two, you're managing the legal obligations, which boil down to who owns it and who has control over the decision making. So Mark's talked about that, Kendall's talked about that. I just want to kind of pull that all together, and that's all determined by the box, the container you choose. The container you choose determines who owns it, who has authority over it, and how it's taxed and how the money goes in and out of that. So the containers have different rules based on which one you choose. So a corporation, for example, Kendall mentioned, if you want an ownership agreement in a corporation, you will have bylaws, just like she mentioned. But if you have multiple owners, you also want a shareholders agreement that has some buy-sell provisions in it. So when one of the owners dies, Mark's going to be like, he's nodding his head. Yes, when one of the owners dies, that agreement's going to say what happens to that. And Kendall's going to nodding her head because she's like, yeah, because there's some life insurance there that can be used to manage the ownership and the exchange of money when one business owner dies. There are so many options here that there's not one rule that says this is a good way for you, this is a bad way for you. It's really going to be case by case specific. And if it's just you and your spouse owning the company, you're simplified quite a bit, because the law is going to come in and govern like legally married people. The law comes in and governs that more so than if you are not married to your business partner. Maybe they're a life partner, or maybe they're just a business partner. The law doesn't have anything for that. The law says, hey, if you're a business owner, you're pretty sophisticated then, and you're going to have to look out for yourself. The law is not going to step in and take care of you like it does with all this other stuff. Like, you know, they take care of, the law takes care of employees. The law takes care of consumers so that they don't get taken advantage of by unscrupulous people. The law has nothing of like that for business owners. And it says, if you're sophisticated enough to be a business owner, then you're sophisticated enough to put these things in place for yourself. So just be aware of that. There's no safety nets there. So you need to have these things in place. And depending on the type of container will determine the types of things that you need to have in place. One of the things I will say is that your container, you may think is set up, but we on the legal side see a lot of times that they are not fully formed containers. So a legal entity is what I'm calling a container. A legal entity is an LLC or a corporation. I don't care how it's taxed. On the legal side, it's born as an LLC or it's born as a corporation, period. Some people think, and because I love the whole social media TikTok thing that Kendall was like, you know, the whole like scoop on the street, so to speak, is that, oh, LLCs are great. They're so easy to form. All you have to do is go on Sunbiz and file your articles and then get your EIN and you're done. Well, I hate to break it to people, but you know, the law is a lot more complicated than that. If anybody says to you, oh, it's so easy, and it has to do with the law or something legal, you know automatically that's not true, right? It's like saying, oh, the government thing was so easy. Like, no government thing is ever easy, and no legal thing is ever easy. So if you ever hear that, you have to question, what do these people really know? Because when I see things come in, I see LLCs all the time that people bring me. They are not even halfway formed yet. They are just barely formed. They're just the initial steps, but they didn't finish it up. So you don't even have a container yet. You don't even have a full liability shield because you didn't fully set it up. So the DIY dangers are twofold. Number one is that you're listening to TikTok or social media, or your neighbor down the street who set up a business and they said it was so easy and this is how you do it. Or number two, you've gone online and you've used a DIY service online. And there's so many, I can't even name them anymore. Those are all DIY services. So you tell them what you want. They say, how do you want to do this? How do you want to do that? And you have to know enough in your mind to tell them what to do. And then they set it up for you. Well, people think, oh, well, if I'm doing it wrong, they'll tell me. They don't tell you. They just put your name inside their templates and they give you the template. Just like, the story that I've told a million times, two business partners come to me and they have this massive conflict and they pull out their operating agreement and they got it online through one of these DIY services because they just typed in their names and voila, everything was spit out to them and it was super cheap and they think they have this formed company. Well, the operating agreement was horrendous. It was bad for both of them. Neither one of them liked it once they got to their conflict. They didn't even know what it said. And they're bringing it to me and they're like, okay, here's this conflict. And I'm looking at this, I'm like, what does this even like have to do with you? They're like, we don't even know what it means. We don't even know what it says. That's the DIY danger online. So, the other one I love is that, a client came to me and brought me a contract that was actually, he got it online, not through a DIY service, but he just like Googled it and it popped up and he's like, oh yeah, bylaws, or I can't remember which contract it was exactly, but it was something like bylaws or something that governed the container. It was US Virgin Island law. So it wasn't even Florida law. It was US Virgin Islands. Said it governed this company, that the company had to follow US Virgin Islands laws. And I was like, where did this come from? He's like, well, I didn't even know that was in there. Like, what's the difference? I'm like, well, every state, has its own set of laws, as does the US Virgin Islands as a territory. It has its own separate set of laws for businesses to follow. And you choose basically which laws you're supposed to follow. So if you set up in Florida, you typically follow Florida laws. That's how it works. If you want to subject yourself to another state's laws, that's fine, but you better have a reason for it. You better know you're doing it and know what those rules are. So just online DIY is really, really a big danger right now. I think people tend to want to do it the easy way. Or I hear people say, I want to do it simple. And to me, simple isn't shortcut. Simple is efficient and doing it streamlined. Efficient and doing it streamlined means just getting it done right the first time instead of having to go back and back and back. And then you end up in this problem and then you have to pay all this money to fix it. So that's my soapbox there. I have already talked about ownership documentation. We can talk a little bit about beneficiary forms. Florida does have a statute that allows you to leave your business ownership as a transfer on death. You have to have that done in a certain way. There's certain language, I call it magic language, has to be in there. But that is a possible, and maybe it's good for you, and maybe it's not. I think that's where Mark and Kendall come in and say, is this something that's needs to be done? Do we want this to happen? Are there tax implications for that? Is there a better way of handling it than just instantly transferring this business on death? And we talked a little bit about partnership agreements also. So that's kind of how we're wrapping this whole thing up here is, what is the bottom line? If Kendall, Mark, if I had to ask you guys, we got some questions to jump into, but if I have to ask you guys, like, what is the bottom line you want people to know about? Like all the things we talked about today, we jumped into some weeds, we came back out, did some high level stuff, jumped back into weeds. Like one thing you want people to take away, what would it be, Mark?
Things don't happen in a vacuum. Just because someone is an attorney or a financial advisor doesn't mean that they have all the answers. You're not going to go to your dentist to have heart surgery. So get a team of specialists that know how to stay in their lane, focus on their area of expertise, and work with others in your best interest.
Excellent. Kendall, what's your one takeaway you want people to know?
Yeah, I wish I would have gone first because mine was very similar to that.
He stole it. He took it.
So I heard a saying, I don't know when I heard it, but it's stuck with me because it's so true, whether in your personal life or your business life. And that is, if you can't afford to do it the first time, what makes you think you're going to be able to afford to do it the second time to fix it? And going on what Mark just said, I understand that when you first start a business, you're like, I can't afford to do all this stuff. I can't afford to hire an attorney. That's fine. But understand that it's probably not as expensive as you think in the beginning when your business is simpler and you have less going on. But you need to aim and save for building a team of professionals like us around you, because changing it later down the road and hiring us when now you're $1 million business is far more expensive, and there's a lot more to catch up on rather than you just starting it from the beginning or close to the beginning.
Yes, all so good. I think my biggest takeaway for you all is, if you hear somebody saying, "Oh, it's easy, do it this way," I think you need to really ask yourself who is saying that, and what are their credentials? Are they qualified to give that kind of advice? And that includes online advice too. When you're doing online research for all these things, whether you're researching financial planning or estate planning or business stuff, you got to ask yourself, who is this person I'm reading from? And are they even qualified to give me that kind of advice? And then go and ask somebody to verify that, somebody that is qualified to give that kind of advice, and ask them, say, "Hey, Kendal, I read this on TikTok. Should I be taxed as an S corp?" And have her look at what your income looks like, and what your financial money management plan looks like, and see what that could actually be for you.
And also, I would say, Lori, is try to understand what their job really entails. Like and I'm going to use myself as an example. When I came to Lori, I didn't have my LLCs for my different businesses were not fully formed, and I thought they were because I had asked an accountant to do it. But an accountant is not typically someone who knows how to fully form a complex business, much less multiple businesses. So I also think that it's important to understand what I do, what Mark does, what Lori does, but also what we don't do.
Excellent. Excellent. Yes. I would say most of the companies that we fix and fully form were actually done by CPAs. I love CPAs. We have a lot of CPAs as clients. We've got some CPAs on this webinar right now. But the good ones are going to be the first ones to admit to you that they do not form entities, because it is a legal thing. It is born in the law first, then it is taxed. So make sure that you just get the appropriate advice from the appropriate professional.
Yes.
And for that, we have actually a few minutes for Q&A. We've got 3 here, really good ones. First one, I think, Kendal, we're going to shoot to you. This is a question about how to best help her grandchild. She wants to know, should she do monthly savings, 529, employ them in her business? How does she begin to know what is the best way to secure financial future for a grandchild?
Well, if you can afford to, I would do a multi-pronged approach. If you live close to your grandchild, it also depends on how old they are. But if your grandchild can work for your business, I would absolutely employ your grandchild, 100%. And depending on how many employees you have, I would also look at a corporate sponsored 529. That's a really underutilized benefit. I think maybe the reason might be, other than people not knowing about it, is that there's no tax deductibility available for offering it. But a corporate 529 is exactly what it sounds like. You can open up a 529 for your employees, and then you can contribute to it. You can match their contributions. You can contribute to it, however much you want. There's no real regulation on that. But a 529 also is my favorite. I call it the sexy 529 because prior to the Secure Act 2.0 in January of 2024, when it came in, was implemented, 529s were really boring. But now you can open up a 529, you can fund it for your grandchild, and now they can roll over after college $35,000 into a Roth IRA, which prior to that, they had to have the income to justify even opening a Roth IRA, much less $35,000 into it. And $35,000 when you're, how old are you when you graduate college? On average, 21. If they did nothing else, that's almost $1 million in retirement. So I would say definitely the 529. If you can afford to, also employ them. I like personally, if you're in the state of Florida, I'm not sure where you are. I have clients in all the different states, but in Florida, uh, an UTMA is something I try to stay away from. They're available to you. An UTMA is where you can invest in a taxable brokerage account for your grandchild, child, someone, a random child not related to you in that way. But you have to give them that money at the age of majority. And there's just something doesn't sit right with me about giving a 21-year-old any amount of money before their brain is fully formed. But that is also an option.
Excellent. Thank you for that, Kendall. Next one is about somebody who is responding to my comment about a single owner LLC. And it says that, you know, she does have a single owner LLC and has been in business for almost 5 years. And what are her options? And I would say that depending on how you're taxed, you know, you've got a couple of different options. If, you know, you're already taxed as an S corporation, then it would be fairly simple to convert that LLC to a corporation on the legal side as well. And that's just a conversion. The ownership stays the same, the EIN stays the same, the tax stays the same, everything stays the same, except on the legal side, it just becomes a blue box instead of a red box, or a pink box instead of a purple box. It goes from an LLC to a corporation, and then you have the full liability shield. The other option is to make it not a single owner LLC, and that is to add an owner. And that sometimes has bigger implications than people realize. Even adding a 5% owner, you know, has tax implications. It has, you know, estate planning, life planning implications. What happens if that 5% owner dies? The same thing happens if a 95% owner dies. So there's other implications to just adding somebody to your business as an owner. I tend to tell people, you know, a spouse, you know, you already have if you're already married and filing jointly, your taxes, then that might be a better option with less implications, but still there are some implications to adding any owner. And then finally it says, you know, what legal entity do you recommend for single owners that want an S corporation designation? And I think that would be same what I just said, is a corporation on the legal side, S corporation on the tax side would be the best option. The IRS is already seeing you as a corporation on the tax side. There's no reason for you to be an LLC on the legal side. It would just be a corporation on the legal side. All right. I know we're 3 minutes over. I thank everybody for staying late. We have some upcoming webinars on these same topics. This was a 101 high level. Here's some general information. We've got some webinars with just the 3 of us that we're going to come in and tackle some of these things. We've got somebody who's married with young kids and starting a business. Or maybe you have a business owner, you're a business owner and you have special needs children, or you're in a toxic relationship with a business partner or a spouse. You're older and you want to pass your business down to your kids or to some other non-family member. These are all webinars that we are planning as next installments to kind of dive deeper into specific situations that have more detailed information. So stay tuned for those. You'll be getting our announcements on when those are. This webinar will be emailed to everybody who registered. You'll get an audio copy of this. And here is our contact information if you have any follow-up questions or just want to follow us on social media. The 3 of us are big social media participants. We're constantly posting things about our areas of expertise, constantly sharing information with anybody who will listen to us, trying to get good information out in the hands of business owners. So thank you so much for joining us. I will put this slide back on if you need it and give you a minute to screenshot that if you want. Mark, Kendall, as always, you guys are awesome. Thank you for joining me today and sharing your expertise.
Thanks for having us. Looking forward to the rest of the series.
Yeah, we tried to put together one webinar, didn't we? And we ended up coming up with 6 different webinars because we have so much information to share. I loved your ideas on those, Mark. All right, everybody. Thank you so much, and we'll see you next time.